All right. Well, good. Welcome on this fine Sunday evening to the first and possibly only episode of Sunday Evening Futures. We'll see about that. We'll see how it goes. But I want to start off by letting everybody know that this is not financial advice. I am not a financial advisor. So please do not trade based on what I say. I am not a pro trader. That's another reason not to trade based on what I say. I'm actually a professional economist. And I practice socioeconomics, which is more of a regional economics, and it's done usually in association with environmental projects. And I kind of do this market analysis as more of a hobby. And I'm doing this YouTube stream because it just kind of was one of those things I wanted to do. So let's get going, and I'll just go over a few of the people that I pay attention to. Hold on, I'm getting sort of a message that it's back. Okay, sorry. These are some of the folks I pay attention to that I get information from, who I think are pretty good resources. But we don't need to pay too much attention to that. What we are going to go over is sort of since this is the first episode, I'm going to start out with a kind of a presentation about where we are in the markets, where we might be headed. What are some of the long-term reads on some of these charts? We'll go over the economic calendar from last week and next week. If we have time, we'll go over some of the recent weekly, daily charts, maybe even monthly charts, since that just closed out at the end of April last week. And then we'll look at live charts of the futures opening. And that's really another reason I'm doing this, because I had often kind of wanted to see some analysis of these futures open, because let me adjust my mic. Okay, thanks. And it just seemed like kind of a cool show. I don't know. We'll see. Again, if it's not fun, I'm not going to keep doing it, but hopefully it will be. So this is where we are in the markets. We had obviously a fantastic drawdown there. Not fantastic in that it was good, just fantastic in that it was large. This is obviously associated with the coronavirus and the shutdown of the economy. And then we had a big bounce, kind of starting on March 24th. And it was a bit, what's the word? It didn't fit a lot of people's perceptions. You know, you have this unfortunate graphics on CNBC. In the back there, you see the best week since 1938. And up there in the front, 16 million Americans have lost their jobs in 3 weeks. So which is right? You know, should we be going up? Should we be going down? And I want to go over some of the debate over that. And so here we go. We'll start with that. And here is Walter Sobchak after his plan was totally foiled. And he wants to say, well, you know, nothing is F, dude. You know, everything's kind of normal. We're not in the midst of a financial crisis. The banks have all the money in the world. Housing will probably be fine. The The millennials are the second largest generation in history, and they're getting into their home ownership primes. The Federal Reserve is committed to sustaining the market. They'll do whatever it takes. We had on that March 24th low, a really strong breadth thrust. And what that is almost every stock in the market went up that day. And usually those are associated with market bottoms rather than the start of a bear market. So kind of the idea is we'll V-shape out of this. There's no reason to freak out. Also, the COVID situation, kind of a freak event. It's not going to last. And when all this ends, there's going to be pent-up demand, and people are going to spend all that money they've been saving by sitting at home. The bears are more like Andy Dufresne here, and they're asking, how can you be so obtuse? The world has been on the precipice of recession for 2 years. China and Europe have been on recession. This virus probably isn't going away anytime soon, or at least the government response to it won't go away anytime soon. The number of jobs lost are greater than any time in U.S. history, which is going to lead to a major decline in consumption due to lower aggregate income. If you have less people working, there's less. They make less money, so they can spend less money. Also, this sort of event might spur higher savings rates. So this decline in consumption may or would reduce state and local tax revenues, further leading to declines in public services and employment. Now, their take on housing prices is, well, maybe the second largest generation is starting to buy homes, but the largest generation is probably going to start selling them. They might have made their money. They're going to sell their second homes. The prices are going to tank. And the millennials are a bit unemployed due to this, and are not going to be looking to buy houses, and certainly second houses like the boomers have been. There's also sort of this the financial system argument that banks are better capitalized. That shows up in the data really clearly, but the system in terms of debt is the largest it's ever been. Governments, or some of them, are at negative interest rates. Corporate debt is at a larger, it's just been going up and up for years, and we'll get to a point where some of that debt can't be serviced. The people oh wait, sorry, lost my mic. Okay, did it again. Plus, the stock market is overvalued anyway in the eyes of the bears. It's at 138% of GDP, which is vastly overpriced, and I guess that's a matter of opinion. So one of the arguments is about the COVID-19 and how long it will last, or how long this government response will last. And one way to kind of get a gauge on that is the trend in new cases. And so this chart I have up here is the 5-day moving average in terms of new cases, daily new cases. And you see, since the beginning of April 2nd, we were just under 30,000, and lo and behold, right here that's from yesterday, May 2nd, we're just under 30,000. And so this curve has been very stable, and it's really anybody's guess as to whether this starts to go down or starts to go up, or just stays stable for a long time. So the question of when and how the economy opens up is still a very, very open one. Now I want to look at some longer term issues, not really issues, but longer term data. And this is a chart going back to, looks like 1997, of credit spreads. And it's the spread between high yield bonds and treasury bonds. And what it means to me is it's sort of a inverse risk appetite chart. When these numbers are higher, that means that people don't want to buy junk bonds. They'd rather be in treasury bonds. There's less risk appetite. People in hiding, sort of, or money in hiding, I guess is better phrase for that. And you'll see, obviously it was the worst in the middle of 2008, but then started to come down. And we had, I've been declining ever since, really, from a trend perspective, and then just had this really big thrust here in March. So this is something to keep an eye on. It's a long-term thing. Does the risk appetite go away over the long term? It's possible. Or this could just go back down. We don't know. That's, nobody knows. But let's take a little bit of a closer look. And this starts in 2018. 2018, this area right here, before this happened, was the peak of the chart. And you can see sort of we meandered down. Junk bonds, people are fine with junk bonds, no problem. Risk appetite was high. And then starting at the end of February, people started to become concerned that these junk bonds, which are put out by companies that don't have the best credit rating, investors became concerned that they might not get their money back on those bonds. So these credit spreads spiked, and then just like the stock market started to go up around the same time, these credit spreads started to come down. And again, something to just keep an eye on. If these credit spreads start to spike back up, you could expect the stock market to start to decline again. So that's one long-term measure. Another one is something that I just made up over the past week that I am calling the MUM index. And this is the XLF, which is essentially bank stocks, divided by gold. And what MUM means is money under the mattress. So this is an index of whether people want their money in the banks investing, like doing things. Do they want their money out kind of working for them? Or do they want it to just hide and not worry about losing capital? And so all the way back in 2005, this started to come down. And this also, to me, represents kind of trust in the financial system. And so this has come down, and in 2008 really crashed down. And then interestingly, the stock market kind of bottomed here. And I don't know if you can see my cursor, but in March of 2009. And people started taking money from out of their mattress, and then they started putting it back in there. And by the middle of 2011, gold was at an all-time high, and bank stocks were still struggling mightily. But that definitely started to change, and you started pushing back up. And around that time, or during that time, you saw the housing market really come back. And in 2012, housing prices started to push up along this trend. Not the same trend, but housing prices started to move up in a corresponding way with this chart. So this started to come back down in 2018. We got like a little peak here and kind of were going down a little bit, and then this thing just crashed. So again, this isn't a measure of do people want to risk their money or not. And that measure has taken a big hit over the last 2 years. Again, something to watch. Is this sustained? Does this keep going lower? If it does, you can watch. You'll probably see stocks fall. If this starts going back up, you would probably see stocks start to rise. And I kind of correlated this with the money velocity, this MV, the velocity of money. If you remember what that looks like, it looks a little bit like this. Not exactly, but this is another important thing. Just money's not moving around like it used to. I can probably take this back a ways. And I mean, all the way back in 1980, we've been trending down. So that's just something, again, to keep an eye on from a long-term perspective. Okay. Now let's go to volatility. Volatility, people call it they call it the fear index. And really it's sort of expected moves in stocks. And do we expect them to move a lot or a little? And these high peaks tend to be associated with large down moves, because markets crash down, they don't crash up. So that's why volatility tends to be higher when markets are in turmoil. And you see some of these kind of events here, and oftentimes they represent a peak in the downside. So that's why, they can be consistent with the end of the worst. It can take time after you get a spike in this measure for a market to bottom out, but it can be associated with the end of something bad. Now, where we are right here, like on the Brexit vote, I mean, this was almost a flash crash. VIX spike really just started to tank. But here we are on our current situation, and the fear index, as it's called, reached a level almost as high as October 2008. And it's come down quite a bit, but it's still at a very high level. We're still kind of close to 9/11 here. We're hanging in there around the Asian financial crisis. There's spikes here that we are still holding above. So again, it's unclear. This could easily start to just level off and go back up. We don't know. Now we'll go to the bond market here. And I think this is it's more of an economic issue than a stock issue. You're not exactly sure how stocks react to major changes in the bond market. But we do know that bonds are correlated with interest rates, and what these charts are, this is the 30-year bond. So as this price goes higher, you tend to see interest rates lower. Same here on the 10-year, higher. I think we all know we have low interest rates right now. And this is consistent with what we looked at before in terms of sort of that money under the mattress measure and the credit spreads, where there's low risk-taking appetite. But it's also kind of our national policy to have low interest rates. And the central bank is doing what it can to keep these bond prices high. And by to do that, they're buying them. That's how they keep bonds high and interest rates low. They go into the market and buy bonds. And the sort of overriding question here that's probably bigger than anything to do with the stock market is, how long can they do that? At what point does the market say, I'm not paying I'm not buying a zero yield bond, and the Fed's the only buyer. And if the Fed is the only buyer of bonds, these bonds are going to crash. And that's sort of the biggest concern. It's more of a longer term concern, but certainly something to keep an eye on. I have heard that the Fed is keeping an eye on it, and what they do to look at that is look at volatility in bonds. And this is a relatively new measure. So if you have very high volatility in bonds, they really shouldn't be moving around a lot. They're kind of, they should be not very volatile. But what we saw here is a couple large VIX spikes in these bonds here and here. But they've, again, everything's kind of normalized. So this would be a long-term thing. If this volatility starts to kind of firm up around these levels and start to kind of just creep up, that's when you might see the actual bonds start to take a major slide, which would change our economic landscape from a sort of I guess you would say a deflationary situation to an inflationary situation. But anyway, I think I skipped some things up towards the beginning, but I think that's okay. I think we have time. I'll just go back and I wanted to talk about the clickbaity YouTube title. And I was listening to a Bill Withers song. I think it's called I forget what it was called, but it's this concept, and it pops up in art from time to time, and this is more the socioeconomic type stuff that I can practice from time to time. This is more even a socio-cultural issue, but it's this concept of nothing so lonely as being in a large crowd of people that you can't interact with. And that may have an effect on this concept of social cohesion that I've worked with in the past. And essentially, we have government policy of social distancing that is directly in contrast with social cohesion. And so that is something that could affect, it's a cultural issue that could affect the economy over time. Something to keep an eye on. I think, we all know there's tensions and stuff like that, but it's best to try to stay cool like Fonzie. Plus, we've also got, these more bailouts seem to be propping up this wealth gap, and that's another thing that could bother folks and start to, especially if unemployment's high, start to piss people off. And there would be economic consequences potentially. Okay, so I think that's the bulk of my presentation. So we've got 5 minutes or so to look at some weekly charts, see where these markets are at. And let's see, is that up there? Okay, looks like we're good on this. But okay, so again, we're seeing this. This is the S&P 500, or at least the ETF that covers the S&P 500. And you know, we see that big drop, this really nice reversal candle here, and kind of been going straight up for weeks and weeks. One of the things that I watch on these charts, you see these lines. These are exponential moving averages, and so this gray is the 200-day, this red is an 8-day, the green is the 21-day, or no, sorry, the 21 period. So these are weeks. So this is a 200 weekly, this is a 21 weekly, the black is the 55 weekly. And I don't look at it because it's, I'm guessing it's what sort of the algorithms look at. From what my understanding is that these trading algorithms care when you get these moving averages cross each other. And here, and one of the important crosses is the 21 crossing below this 55. And that happens when you get a decline. The 21 is faster than the 55, so it's going to slope down faster when you go below them. And when they cross, strangely enough, the market wants to go back and retest. So here, that's exactly what happened. Went up into this 55 weekly, into this cross, tested it, got rejected. If you don't know what these candles are, let me know and I'll try to explain it. But so that's where we are right now. We kind of pushed up into this level. It was going to be tested, got knocked back down. That doesn't mean we're going to go all the way, you know, doesn't mean we're going all the way back down. Could hang around here, could try going back up and retesting. Dow Jones, here you haven't even made it to that cross. So the S&P 500 is performing better than the Dow Jones. Let's go to the NASDAQ. The tech heavy indexes, tech is above all of those averages. It never even got that 2155 cross. It just kind of just really blasted back through everything. Is trying to push near new highs, but there's a lot of work to do. Financials, we talked about those a little bit. Super weak here. Again, you didn't get anywhere close to trying to test this cross. You got rejected by this 8 EMA. And so this is just more of a struggle. This just doesn't look pretty. Home builders, again, relatively weak compared to the S&P 500. The S&P 500 pushed through and hit that 55. This didn't make it. But okay, anyway, we're about to see this future start, and that's why we're here, I think. We've got about 40 seconds. So we'll take a bit of a closer look at this one. On the daily charts, you actually had the 55 crossing below the 200, which is the proverbial death cross. And it's pushed up into that, got to the top of that, so far has been rejected back below that 55 just barely. In 10 seconds, these futures are going to open up. And word is that Warren Buffett sold his airline stocks and is talking bad about the Fed for buying stuff too early, and he wasn't able to buy. He wasn't able to go into the negotiating room and push around these fledgling companies. So he's a little upset with the Fed. And this should have opened. There we go. Ooh. Okay, so here's today. Here's what we're doing today. And this is Friday. This is Thursday. Here's today. Down 32 points, down over 1% in about 10 seconds. So that's this big red bar is bad. But we'll see how this plays out. And I might go grab a water. So I'm going to mute this up and I'll be back in 30 seconds. Okay. Still holding that little downdraft here. And we can look at what the NASDAQ's doing. Same. This is down 1.11%. Dow Jones, about the same. Let's look at, oh, we're starting to push up here. Let's look at gold for a second. Gold doesn't look as bad, but it's red. What's oil doing? Oil's been kind of bad. Look at oil. Yeah. It's kind of doing better than the indexes. So anyway, this is the time in the show where I would talk to people on the chat. But we've only got 3 people, and I might be one of them. I don't know how this works. This is the only time I've ever YouTubed. Might be the last, if we're all lucky. But if anybody wants to drop in a note or has a question, then Jesse wants to know if this show will show up on his TD Ameritrade app today. I could almost guarantee you that it will not. Probably will not. But what you also won't see on your TD Ameritrade app is these overnight futures. So you can watch them here. This can be kind of boring, so we'll go back and look at, what can we look at? We can look at the US dollar. I think that's an important one, and it's just been acting real funky. This is a long-term chart. This goes back to 1986. And I've always found it very interesting that the dollar peaked on 9/11. From 2001 to 2008, it dropped 40%. That's a lot for a currency. And we've been carving out a bottom ever since. The dollar's been getting stronger. During this COVID situation, it got much stronger, and it's sold off a bit, but that's somewhat normal. It's kind of like that mum index, the money under the mattress. This is the strongest currency in the world. It's the reserve currency. It's what people flock to in bad times. They hold that currency. I wonder if this is moving. I don't know if it is. It's not. Well, Yeah, it is. I'm not sure. What else do we have here? We can look at the 10-year. That's moving. That's pushing up right now. Which is consistent with the market coming down. We've got the China dollar here. This is a very interesting chart. This is the wrong one. But when this thing went over 7, the world freaked out. It was essentially China devaluing their currency. And it's hung up here. And I guess you could say the world never ended, but it, we don't know that either. Bad things eventually did happen, and there is some talk about them trying to devalue again. Here's this VIX. The VIX moved from here on Friday, opened up almost 11% just today. Oh, no, this is old. Sorry, I'm new at this. We'll go back to the S&Ps. And then I see some questions. Oh, Jesse, yeah, I don't think the futures will show up on your TD Ameritrade app. They might, but I wouldn't know. Airlines. Do you have a particular airline you want to look at? We'll go with Delta. That's just an ugly chart, man. So you kind of got to push up here, and then it just got totally rejected. And this is a classic, what they call a bear flag. If you want to draw a picture of that. I mean, I'm not going to make a perfect one, but looking like this. Something like that. Where we'll do something like that. This is the worst one ever, but it's a formation like this, whereby you've come down quite a bit and you're consolidating here at the lows. And it's just a shakeout here, trying to draw in buyers, and it tends to go lower. If this thing doesn't break out quickly, the predominant trend, which in this case is a downtrend, will persist. Save. Same. I mean, this is just a classic bear flag. You got this rip down, and then you're just hanging out down here. So, and this is funny. You see, this was down 12% on Friday, and then Warren Buffett comes out after that and says that he's sold. So, funny how that works. Back to how these futures are moving. So you'll see on the futures chart, we kind of hit this 21. It's 21 EMA, and also what I believe is a 50% retracement from the high to the low. And so we'll see if we get a bounce off that. I would imagine so, but who knows for how long. Jesse, did that answer your question about save there? All right. Kind of. Well, we can go back. We can go back, man. We got all the time in the world. This show's probably kind of boring. Even I'm bored. So I appreciate if the other two people are not robots. I appreciate you hanging around. What can we look at here, Jesse? We can look at... We can look at a shorter term chart where we can get a little bit more information. And I guess what you have here, you had a pretty good move on April 28th. You're up 14%. And then from that, I mean, in total, this was a 33% move. And then it sort of ended in this buying climax in this, what looks like a reversal candle, where you gap up over this resistance line, over that black 55 moving average. You gap up there, kind of get rejected. This wick right here, you see this little wick. Essentially, it lost its momentum there. I think that same day, that same day, it sold off a bit, and then you've tanked ever since. Okay, we can look more at that bear flag. I'll try to draw a better one. I would go from here. No, I wouldn't go from there. I would do something like this. Ugh. I don't know. Well, knowing what we know now, I would do it like that. So you can kind of see it like that. And you're still in it, technically. But we'll see what happens after the after trade tomorrow and Warren Buffett gets his way. He beats down those airline stocks until they're worth zero and then buys them. I think that's what he wants to do. Back to the futures. Take a little bit closer look. Kind of hanging in there. You know, if this doesn't if this doesn't break down, then it could be seen as sort of the Warren Buffett freak out, you know, and people could buy this. We have some indicators down here. Ooh, that's interesting. We're on this 4-hour 200. So again, that could be some support. But yeah, it's I guess something I found interesting last week was on this 4-hour chart. This happened overnight, but I had this line drawn. It's a horizontal trend line. And the market broke out above it overnight. This was the same day the Fed came out on I think Wednesday. And there was just continuation overnight above this line and above this 618 Fibonacci, which is a important technical indicator that a lot of people look at. And so it kind of, with these 4 bars, kind of did a little bit of consolidation above those areas and then just got smacked down. Really got smacked down. And we are still amidst the smackdown. But at the same time, you look at this and you're looking for higher highs and higher lows in a trend. And we still, if you want to look at this as the I guess the low in charge, you pushed up, you had a low here, you pushed back up, you had a low here, you pushed up again, and if you don't break this low, you're still in that uptrend. So Walter's right so far, nothing is effed. But if we start breaking below this level, about 2730 on this futures chart, then you probably, not immediately, but eventually want to start thinking about lower highs and maybe lower lows in the near term. Okay, we can look for at CCL here, Jesse. Oh. Yeah, that's another ugly bear flag you got there, Jess. So, and it's starting to roll over a little bit. This is a stochastics. It's not exactly the most reliable thing in the world, because you're looking for this blue line, which is the fast to switch over across the slower version, which is the red, and that's when you're looking for a trend change there, and this would indicate a trend change to the downside. However, I mean, you can't necessarily just believe one indicator. You never know what it's going to do. But yeah, it's not looking pretty there, Jess. What is? I don't know. Microsoft, maybe? Microsoft is one of the strongest companies in the world. It might be the largest company in the world in terms of market cap. This has bounced back most of the way, and it filled this gap, so that's nice. But now it's starting to level off. It was going up, and now it's sort of just doing this straight line across the way. We'll look at the NASDAQ futures. Yeah, I mean, you've cleanly broke below this red 8 exponential moving average, and the question by the end of the day, where does this close? If you close above that 8, then that's pretty strong. If you close above that 21, that's pretty strong. So there's still an uptrend. That's kind of the takeaway that I have. Unless we start to break these lows, we're still in a strong uptrend. I don't know about Tesla. Jesse, getting in real low might not matter if that flag breaks, because then it'll go to new lows, much lower lows. So your cost basis won't matter. If you got it at 8, you still might have to sell it at 4. If you wait. Well, you could do that, yeah. You could do that. Like Warren Buffett. All right, but we'll take one more quick look at the hourly, because I think that's what we were focusing on. And still kind of hanging out there, haven't pushed down much further, only down 1%. Not the end of the world given the news that Warren Buffett is selling his airline stocks. NASDAQ, a little bit stronger. Dow, about the same. This is the Russell, and this is like small caps, and they've been weaker than most. They've kind of been pumping and dumping. Oil's starting to take it on the chin, down 3%. And gold, not doing much here, only down 0.1%. Okay, given that, I think I'm gonna wrap this up, and I appreciate sticking around for as long as you did, and we'll see about whether I'll be back next week. I'm kind of doubting it. We'll see. All right, thanks everybody.